Welcome to Premium Option, the channel that is designed to help you learn and profit from the stock market and options trading. Now, if you guys are brand new here, we would highly appreciate if you could subscribe to the channel and like this video. It really helps out the channel a lot. And if you do find any value from it, we'd really appreciate that from you guys. But today we're going to be doing a quick example and a little rundown bird's eye view on Leaps. Now, if you've never heard of Leaps, then this video is exactly for you. This isn't going to be a very in-depth video because there's so much to cover, but I do want to give you guys a little lick, a little taste, get your toes wet of why Leaps are so great and why you should definitely consider them if you're a person that likes to hold stocks long term. But again, if you are brand new, make sure to follow us and also join our free Discord. It's completely free for you guys. The link is in the description down below, and we talk about everything from market updates, market news, options trading, and just a bunch of other cool stuff for free for you guys. So let's just get into the video and let's stop boring you guys to death. So LEAPS stand for long-term equity anticipation securities. You don't really need to know what that means, but the anticipation or the AP in Leaps comes from anticipation, just in case you were wondering. So put simply, it's a call option with an expiration of 1 year or more out. Now, the reason you'd want to do this instead of holding 100 stocks is because it's just better. In my opinion, it's a lot better. Now, let's actually go into why and let's explain it a little bit more for you guys. So basically, when you're holding 100 shares or 1 share of a stock for a long term, you're trying to basically gain money on it. So if you buy it at 100, you're hoping in a year or more, it's going to be above 100. That's how you make money. It's the same exact thing for this call option. It's basically a call option with a very long expiration. Now, some of the really important things that I want to cover is basically right now, just for this video, is the premium. Because when you're owning 100 shares of a stock, or at least a LEAP option, it's almost the same as owning 100 shares. Now, the premium for me is what's really important. So let's actually talk about a couple of the things and how it ties into that. So as you can tell, let's actually go into a stock right now. Now we have ticker symbol of VOO, the Vanguard S&P 500. And let's just click on something that's over a year out, which would be this 2023 January call. Now we're over a year and a half out, and let's go to the share price of $400. Let's drop way below, because we're going to do the one thing with Leaps is you want to be very, very in the money with this. The main reason is because you want a very large delta with these types of Leaps. And the reason is because you want to resemble as accurately 1 share to 1 call option. So basically, the higher the delta, for every dollar that VOO moves, that is what your options price is also going to move. So the higher the delta, the more realistic it's going to be as to owning 1 share or 100 shares of VOO. So let's just go to something that's like 0.95. Now you can see that the premium that you're going to pay for this is around $20,000 just for 1 contract, which is mind-blowing. But again, remember this. You're owning 100 shares of VOO, which if you were to do that just outright in market order, it's going to be $40,000. If you were to do this on an options contract, it's half the price, less than half. So a couple key things to remember. There is a substantial premium that you're going to pay because you're paying $100. You're paying for 100 shares, very in the money. So the premium is going to be high. But again, at the same time, it's probably going to be more than half of a discount than what it would to just market buy. Another thing is you want to make sure that your delta is big because you want it to resemble like you're owning 100 shares of this stock. And basically, at the end of the day, it's like you're owning 100 shares of this at a 50% discount. Another really important thing to remember is that the theta is very low. Since your expiration is more than a year out, your theta decay is basically non-existent for most of the time until you get within 30 days. So the really awesome thing with this is Leaps are basically like you own 100 shares of a stock, but you bought it at a very steep discount. That's the beautiful thing of Leaps. That's like, if I could end the video on that, that's basically what it is. Now, I do want to show you a very important example of why this is. So right here we have VOO pulled up on TradingView. Now I have a couple of key dates that I want you guys to really focus in on. So right here we have February of 2020. This is right before the market dropped. Now let's say you bought call options for a month, you would lose money because the market dropped 35% in a couple of months. Really killed anybody who was bullish on the stock market. But let's say you bought a leap option February 2020 and it was exactly 1 year out. Even though you could have bought at this all-time high of February, if it was a year out, February 2021, the market rose 12% from this all-time high, even after the crash. So owning long-term in general is just always a good idea because typically long-term stocks and stock market will go up. Now, that's just one example I want you guys to really focus in on. If you were to own this for just the long term and just let it hodl, even though everything is falling in these couple months, even after the market crash, you still would have made money on this just by owning it for a year or even more. So as we come back into this, I do want to talk about some pros and cons of this because there's some important ones, because it's not as simple as just owning 100 shares of a stock at a discount. So a couple of the really nice pros of this is that when you're trading options, typically they're shorter term. So you're going to be paying short-term capital gains. But with leaps, since they're a year out, any profits that you make are going to fall under long-term capital gains. So the percentage of taxes that you're going to pay on your profit are going to be exponentially lower, which is a really big plus. There's another really nice thing of a high delta. So it's going to resemble like you're actually owning 100 shares of a stock. The higher the delta, the more realistic it is that you're owning one share for basically that option. Another really nice thing is you have a huge discount on the stock. If you wanted to just go out right now and buy 100 shares of VOO, you're going to have to pay over $40,000. But if you want to do a very, very, very in the money option call, you'd only be paying less than $20,000, which is more than 50% off. And another thing is that it's long term, which as we saw with the TradingView example, long term typically is better. And that's just kind of how it is. So those are some of the pros of it. Those are why leaps, I think, are very beneficial and honestly better than owning the 100 shares. Now, a couple of the things that aren't good about it is you don't get dividends. As you can see, VOO pays 1% per dividend, or 1% for their dividend. And since you're having a leap, since you are buying a call option, you actually don't own the shares. You just own the contract that is the right to buy the shares at a later time, at a later price. So you don't get money on dividends. Now, if you're buying a stock that doesn't give out dividends, like Amazon, Palantir, NEO, Tesla, things like that, then you're completely fine. But if you're buying stocks like ExxonMobil or Verizon or AT&T and they give out big dividends, you're going to miss out on a lot of that. And if you own 100 shares of that, that's a pretty nice, decent amount that you're missing out on. And again, you are doing a long-term bet, which again, sometimes is not always the best, because if you're not picking the S&P 500 or whatever, and you pick a stock like Tesla at all-time highs back in 2020, they've been kind of just fluctuating and falling down this entire 2021. So again, sometimes long-term isn't really the best depending on what stock you're picking and especially what sector you're picking, because if you pick long-term for travel or anything like that, you're definitely hurting. So it's also really important because your money gets tied up in that. So that's something important to remember as well. But I just want to end that video on that note. If you guys did learn anything about Leaps options, if you did find anything valuable in this video, I'd really appreciate if you guys could subscribe and follow. Really does help out the channel. But we're going to do more in-depth videos in the future. I just wanted to get your toes wet and make sure that you guys kind of understand the power and possibility of Leaps and why it's important to look into them. So I'll see you guys in the next video. Peace.